Good afternoon, everyone. Thank you for joining our Money Matters, which I call our Lunch and Learn for our emerging developers. I'm excited to have Ms. Julia Stevenson here, originator for strategic investments for the CDFI, a branch of the CDFI LISC. As we do, these programs are dedicated to providing additional information for our emerging developers, individuals that are just getting into the market of development. And today's session is to really talk to you about how to get access to capital and what your funder or investor is going to be looking for. Because there's one thing to find a project, but if you can't fund it, it's just a pipe dream. So without further ado, I'm going to hand it over to Julia. We're excited to have you. Thank you for being such an exceptional partner. And as you start, please share your expertise, why you are a value add, and looking forward to your conversation.
Yeah, thank you very much. It's an honor for me to be here speaking with you all. Titus, I think I recognize your face from before when we had the happy hour event. So good to see you again. I want this to be very interactive. I want to make sure that I'm serving the need here in terms of just insight on what's helpful. I do have a PowerPoint that I want to use to help move us through the conversation, but at any time, please feel free to unmute or use the chat to ask questions. And Dolores and Nikki, I appreciate you, helping to direct my attention to the chat if I miss something. So I will share my screen. I think this is the right screen. Okay, are you seeing the first? Okay, great, the title page. Okay, again, thank you for having me. I will move through the agenda talking about LISC versus LISC Strategic Investments. I work for LISC Strategic Investments, which is a wholly owned subsidiary of LISC. So we'll talk a little bit about that. I'll share a little bit about myself and why I am able to offer the perspective, how I got here. And then we'll go through the process of a deal. Typically, we call it intake. Typically, a deal starts with some form of intake by either the relationship manager or the originator, or whatever the front-facing representative of the institution. And then we'll talk about some other points that are really pertinent to especially developers of color, but emerging developers that are forging either a new path in development or growing their business to be able to access institutional capital. So LISC is a nonprofit community development financial institution. It was founded over 40 years ago by the executives of the Ford Foundation and was primarily started to support the community development initiatives of cities. So we have a local office in 38 cities. And over the 40-year span, that mission has evolved to include rural areas. So there's a LISC rural, and then a number of other initiatives that support that community development cause. So you'll see if you go to our website, and I'll be sure to add some websites in the chat afterward, but if you go to our website, you'll see sports and recreation, you'll see safety and security, you'll see a number of initiatives that have their own kind of programmatic intention that's all ties back to community development. In addition to our local offices, there are affiliates such as National Equity Fund, which if you've done LITEC deals, you may be familiar with them. New Market Support Company, if you have looked at new market tax credit deals, you may be familiar with them. And then IMITO is, I think, a relatively new affiliate entity that's targeting small business initiatives, small business lending. And so LISC Strategic Investments, again, is wholly owned subsidiary. So we are directly under the LISC umbrella as opposed to being an affiliate entity. And our mission very much aligns with our parent company. I wanted to share a little bit about, hold on, let me slow down. I think I may have clicked too many times. Okay, I wanted to share a little bit about our leadership. One of the great things about LISC Strategic Investments is that there's diversity in our approach to investments, which allows us to kind of deviate beyond the box of what our community development parent does. Community development financial institutions is a specific, I'll call it a designation under the U.S. Department of Treasury. Typically, community development financial institutions create lending products that look a lot like banks, but are more flexible in terms of the parameters, higher loan to value, willing to do some of the more riskier project types with newer sponsors, and offer grants. So LISC is the largest in the nation, but what LISC Strategic Investments is able to do is creative investment structures. So we're not necessarily partnering with banks and insurance companies. We're able to take capital from corporations, and I'll go into the Black Economic Development Fund and just lightly touch on some of our other funds. But first, I want to just point out the benefit of the diversity in our leadership. So the diversity in our investments, the diversity in our leadership allows us to just be a very nimble firm. We have several funds, several investment vehicles. I don't think that this captures all. We have some in the making, but this just gives you a sense of how much we're doing and kind of helps you see like what are the focuses. So in support of our parent company's mission to target affordable housing, you'll see several of the funds have an affordable housing focus. I primarily originate and deploy capital for the Black Economic Development Fund. It's a $250 million private equity fund. Our corporate, the corporations of Silicon Valley and some of the nation's larger corporations are investors. And we are targeting Black-led, Black-owned sponsors. And this fund was created really in response to corporations trying to figure out their social responsibility in the racial reawakening triggered by the murder of George Floyd. So in response to what individuals, families, institutions, and in response to the national dialogue around racial inequities, corporations started to look at how their dollars were being used. And so the Black Economic Development Fund was originally created with the thought of investing in Black-led banks and expanding their opportunity to be impactful in the communities that they serve, and then has evolved to include business investments, real estate investments, and other types of investment opportunities that support the Black community. So about me, how it started. I came into commercial real estate through a very winding path. I was competing in track post-collegiately, we'll call it professionally, and had an opportunity to meet a woman, a developer who was a Black woman like me. She went to Brown University like me and studied urban studies like me. And that's how I came into this field. She hired me as a project manager and allowed me to continue to train. And I learned under her a little bit about commercial real estate and the lens of a developer. And from there, had an opportunity to work as a project manager and development associate for a local government in the DC area where I'm based. So from that experience, I got exposed to affordable housing. I got exposed to working directly with the tenants. So I had the benefit of seeing things a little bit from your lens, but not quite with the same risk as being out there on your own. After getting involved in development with the county, I started learning more about finance and reading pro formas, and it truly intrigued me. And so I decided to pursue a master's of finance at Johns Hopkins Carey Business School. And from there, I dove from development to real estate finance and took a job with a local bank, Eagle Bank. That bank had $10 billion, or I think maybe it was just shy of $10 billion of assets under management. Our CEO was a developer. So unlike most banks, we drove most of the revenue in the real estate group. And by our CEO being a real estate developer, we were able to get comfortable with a lot of different transactions. So I've underwritten commercial real estate from office, retail, multifamily, land deals, pre-development townhome lots, subordinate, senior, business loans, working capital, everything related to real estate, including industrial. I think the only thing that I have not underwritten is a database, and I just got approached about a database deal recently. So a lot of different deals, a lot of different asset types. So again, please feel free to ask me questions as we move through this, but I wanted to share a little bit about myself so you can understand, one, why do I get to be here with you today, but two, have some confidence in when I tell you my insights on access to capital. So typically when you are pursuing financing for your deal, either the relationship manager or the originator like myself, we're going to have some form of taking in the deal and do a preliminary analysis to see if it has legs. Can this deal move through our approval process? If it's a construction deal, is there a viable path to delivery? Is there a market for the unit once it's delivered, or for the asset once it's delivered? So, you know, a lot of people, I think, are unclear on the timeline when it comes to their deals and when to come to the institution. I would say the earlier, the better. However, if you don't have your project, you know, if it's a land deal, if you don't have it under a purchase contract, a draft of a purchase contract, it's going to be hard for someone like me to make time to assess the deal, because there's just not enough evidence that you'll win it and that this is going to be a good use of our time. And it's not that you yourself aren't valuable. It's just that we make our profit from being able to move through deals quickly, identify the ones that we want to invest in, get them funded, and ensure that the risk is mitigated so that they can deliver and repay us. So overall, your package, when you present them to us, should take us about 30 minutes to digest. And it should be in a stage where you're not crammed up against a closing date, but you're not so early that you know, it's still very speculative for you to pursue the investment opportunity. So at the Black Economic Development Fund, I typically tell clients to allow about 60 days. There's a few weeks to assess the deal, then there's a few weeks to underwrite it, and then we present, and then there's time to close and have opportunity to negotiate the loan docs. How do we look at a deal? Some people approach it with the project narrative. I like to start with the model, but in any event, it's very important. I don't know if you can see my cursor, but it's very important that consideration be given to the sponsorship group, the borrowing entity, and the individuals that are controlling the decisions. So if you're working with a conventional bank, if you've had this experience already, you'll know that they want to identify who owns greater than 20%. That is a financial regulatory requirement, but in essence, what that is after is just trying to understand who controls the deal, who's making the decisions, who's responsible for helping to mitigate the risk. And then from a guarantee standpoint, who's going to serve as the guarantor? Who's going to have to put that skin in the game to make sure that should, you know what, hit the fan, our principal gets repaid. After we get comfortable with the sponsorship entity, then you start looking at the project itself. Does this developer have a sound business plan? Have they thought through the risk related to the market? Do they have an asset that is, has viable exits? Like, what is the project itself? And what's the plan for the asset? And do we think that this sponsor can deliver on that plan? And we'll go into a little bit more detail about project and project risk in the next slides, but that's a high level overview of how we think about this process. And then just in general, what's the rest of the capital stack doing? And here I've just kind of spelled out a little bit. I don't want to make any assumptions, but typically I've primarily worked with debt for the benefit of a developer. I've had to model out equity, but essentially we're just looking at where do we fall in the capital stack, who else is in the capital stack, and how does their position impact our collateral. Any questions? And just come off mute if you have them, because I don't see everyone's face.
Yeah, I have a few questions.
Sure.
For the timeline with closing, it says closing takes 3 to 4 weeks. I'm just wondering what impacts the duration for closing the actual financing.
I think some of it is the transaction itself. Some of it is the sophistication of the sponsor or the borrower. Particularly with our fund, we want to make sure that you, our client, is very clear on, the loan documents, and you've had time to, read through it, ask questions, negotiate any outstanding items. But overall, I would say it's a matter of when the attorney starts to draft the documents, when they're able to circulate them, and that actual process of bringing the equity to the table, making sure that the settlement, all the title insurance, long lead items, sometimes that gets built into that closing period.
Got you. And then I had a question about I think you called it the capital stack.
Mm-hmm.
There's some terminology in there that I'm not too familiar, such as like mezzanine and participant. Can you explain a little bit of those as well?
Absolutely. So for mezzanine, some people call it mezzanine debt or mezzanine equity. That is literally referring to being in between the equity and the debt. So typically mezzanine is not, it's still funds that you get. It can be from a hard money lender. It can be from a traditional lender. But you don't get a collateral lien position. Typically you get a collateral position against the ownership interest. And so your remedy, if the deal went south, would be to step into the ownership, versus mine, which would be to take the asset. When I have participant, that's really referencing a loan participation. And so, I have a deal now where a large bank is the construction lender and they don't want to go above 65%. Well, I didn't want to share second position, even though I'm providing subordinate financing. And so we allowed another entity to come in and participate out the difference between the 16 and $18 million number. So they're going to take $2 million. And the way it works is that, let's call it Bank of America. Bank of America does a $16 million loan. And where are you based?
Well, I just moved from Oakland to New York.
Okay, so let's call it Invest New York. Invest New York is going to buy $2 million participation so that Goldman can do an $18 million loan and then sell the $2 million. And that way it's off of their balance sheet. They lessen their exposure. But as far as my interaction and your interaction, there's one senior lender. And I think they share the first position. But the participation can be structured in a number of ways.
And LICS is typically the first position. That's what you're looking to be in, or do you ever take equity positions as well?
So I'm LISC Strategic Investments. And so out of the Black Economic Development Fund specifically, it's only debt. But say your deal was in Charlotte. the fund that we support that's place-based, it's in Charlotte, that provides equity and debt. So it just depends on the fund, which is why, it's important to know your audience and know who you're talking to and make sure that they give you all the information in terms of what products they have to offer. But yeah, so for me, it would be the Black Economic Development Fund, and we would be looking to be first lien position, but we also can be second lien position. And just in case it's helpful to anyone, the reason why we would be attracted to a subordinate position, a second lien, say Titus, that you have a $50 million deal. Let's do 100, so I don't have to worry about embarrassing myself with mental math. Say you have $100 million deal. Our investment size is only 1 to 10 million out of this particular fund, the Black Economic Development Fund. So we wouldn't really be able to compete for senior loan position for the debt. You would have to find someone, say you found someone to give you 65%, that's still 65 million. But say you just need 10 million more to really make your equity position comfortable. Like you have an equity partner, but they're not going to meet $35 million. They're not going to write a $35 million check. They will, however, write you a $25 million check. So then in that case, it would be helpful for us, and it will further our mission of supporting you as a Black developer if we did that $10 million gap. So, that's how you can think about leveraging subordinate financing and folks that offer that product.
Makes sense. Thank you.
You're welcome. So I always like to include a sample term sheet. In my experience, and I've been in the industry for 15 years, and I've underwritten I've at least underwritten over $400 million in real estate related transactions. A lot of times my sponsors were predominantly white developers, and in the DC area, they were some of the largest. And so you assume there's a lot of experience there, a lot of ability to negotiate, a lot of leverage when it comes to negotiating. But then when I would work with my sponsors of color, particularly Black sponsors, they wouldn't negotiate. And I've concluded that it's because there's not this comfort with knowing, there's not an awareness that you can negotiate, and there's not a comfort with knowing what to negotiate. So I try to use these opportunities to talk about, what's negotiable on these term sheets. Does anyone, and again, you'll have to come off mute because I can't see you. Does anyone have experience with term sheets? Just so I can know how to direct this part of the presentation. Don't be shy, y'all. Listen, I'm from Detroit, Southern roots. We're all friends here. Okay, if anybody is going to come off mute, just feel free to do so. I'll keep going. Let's say that this is a construction loan term sheet. The typical makeup of the term sheets are, just identify who the borrower is, what the loan amount is, the term as in the long term, the address of the project, and a little bit about what will take place, how the loan proceeds will be used, extension options, the remedies, the recourse. You don't always see an equity requirement, but I would say it will behoove you to have that included so that there's no confusion around how much cash you have to bring to the table. Origination fee. Exit fee is not something that I think is typical of banks. If it is something that you see from a bank, I would say try to negotiate it out. From a fund, I believe it's pretty standard. So you would have a hard time getting a fund to negotiate that away. The repayment structure, the collateral, and the position of the lien. Interest reserve and operating reserves are not always. Again, I would say this will behoove you to have that spelled out in your term sheet. And that's because I think it serves you to focus on building the asset versus figuring out how to pay the monthly debt that's due. the conditions to closing, and then the covenants, the reporting requirements during the loan. So if there's no questions on what's on the term sheet, I'll talk about like what you should negotiate. I see you came off mute, Titus.
Yeah, so I guess I have a few more questions. For interest reserves, so operating reserves is just making sure that you have enough money to cover the loan payments, but what are the interest reserves again?
So interest reserve is covering the interest only debt service due, and that's typical of constructions or assets that aren't going to generate income right away. So if it was a
Okay,
business,
so
go ahead.
that's just based, so it's the type of loan, if it's an interest only loan versus if it's interest in principal?
Yeah, so if you have a deal that, say you're buying an existing, let's keep it multifamily. Say you're buying an existing asset. Maybe it's a value add, maybe it's a core. So there's already tenants and it's already generating revenue. In that case, I'm probably going to look for principal and interest to be paid during the loan term. And maybe I have an operating reserve just to help you in case you're not soundly hitting a 1.0 when you take over the loan. And when I say 1.0, I mean the 1.0 debt service coverage ratio. If it's a construction loan, or say it's an asset that is only partially occupied, you should be able to get interest only debt service throughout your loan term so that you have the opportunity to just pay the interest, and there should be an interest reserve funded by the loan. Now, if you have an equity partner or you yourself have a lot of liquidity and you prefer not to pay because it's considered capitalized interest since it's loan funded, you're using money that's costing you to pay the cost of the money. So if you have liquidity, then you can just maybe have them set up an interest reserve account with your cash, and then they pay the loan on your behalf out of that. But typically having it be loan funded, I would say, is the not less risky, but I would say most advantageous way of doing it. And that way they're responsible for tracking it. And then you just have to make sure you agree to the terms. Should you run over the scheduled construction time or whatever the scheduled time is for that aspect of your business plan, you can negotiate what happens in terms of you having to supplement with equity or you being able to get an increase to the loan to cover the delta.
And you said something interesting regarding, like paying the interest only payments with capital that is borrowed. Mm-hmm. And I feel like in terms of like running those numbers and calculations, it gets confusing for me. I kind of just have a question for the group if anyone's had experience with that and has any type of like formula to calculate how much, based off of like duration or how much you actually have to pay back.
Matt, I see you came off mute.
Yeah, I can speak to that a little bit. I think it comes down to the Excel modeling and like you don't have to do it in your head. You need to be able to really see what the project can afford with all those different inputs coming in. So it's a bit of maybe a learning curve of setting up a financial model for a project and being able to say, all right, if we finance the interest up front, how much of that, like how does that affect the cash flow over a period of time? So it's hard to do it in your head. I don't think anybody can do that. It's a matter of knowing how to set up those inputs and assumptions and kind of look at the core metrics of a deal within the model. But Julia, would that be accurate in your view?
Yes, and Titus, I'm happy to share with you a link that I like to offer that gives folks templates. And those templates that I recommend, at least for reference, often include an interest reserve line item and a calculation already built in. But as a practice, what I typically do is for a construction loan, I'll take 80% of the full amount of the loan and multiply that by the time period. So if it's an 18-month loan, 1.5. Oh, sorry, no, I take the principal, 80% of the principal amount to get a number that I think will be outstanding, and then multiply that by the interest rate and take that number by the time that I think the loan term will be. So if it's 18-month loan, then 1.5. So how much interest do I think will be due over an 18-month period? And the reason I take 80% of the principal balance is because you're not going to be fully funded day one. So the majority, typically people have an S curve to construction. The majority of the funds being in, call it the middle of the loan term. 80% it feels like a conservative number to capture that you're still going to get pretty high up in terms of using that full amount of the principal loan amount, but it's not going to be 100% from day one.
I appreciate you for saying that, because that was going to be like my next question is, how do you track based off of time? Is that at least gets you kind of in the ballpark? And so thank you for explaining that. And thank you, Matt, for also explaining the model.
Sure, happy to. And I can share some stuff as well with if there's a way to do that after this. I had one question as well, if unless you're going somewhere else, but around the recourse and guarantee side of it, which I think are pretty intimately tied together for that. And to me, it feels like that is the core piece of what makes what makes access to capital so hard for anybody but those biggest groups that have huge balance sheets and tons of liquid capital and long track record, like that they're able to negotiate because of those things. And it's often hard to get over that hump in order to do an interesting deal and get, good financing from a bank or otherwise without that. So I'm curious kind of how you think about that and how you kind of overcome that big hurdle.
So if I'm capturing your question correctly, it's like, what ways are there for folks who don't have that strong balance sheet and reputation in their area to negotiate? So I think that, again, being an advocate for yourself means making sure that you are building out your network to include relationship managers, board, bank board of directors. And how do you do that? Well, there's a lot of different communities. ULI is a membership community. For women, commercial real estate women is a community. These are national entities that create these opportunities to attend conferences and get to know folks. Locally, a lot of times regional banks will have a lot of sponsorship of events and panel discussions. I would say attending those events and just kind of getting to know people. And with real estate, it's funny because a lot of people exchange business cards, but it's really only after you keep meeting people that you develop a relationship. So I would say just making sure that your presence is known and that people are getting to know you and not seeing you as the Black developer, but seeing you as Titus Garrett or Matt McFeely. Making sure that they can say, oh yeah, Titus moved from, here in DC, it would be Jair Lynch, but maybe in New York, it's Donahue Peebles, and now he stepped on his own. Maybe they say, oh, I remember Matt from his days at Clark Construction, and now he stepped on his own to be a developer. I think that's the best way to overcome not having the benefit that a lot of predominantly white institutions have in terms of just being able to throw their money around and throw their clout around.
And if I can speak to this, and this actually is directed with LISC. So when we acquired our 17-unit property in Oakland, and now a little different, we're a nonprofit organization's been around a long time. However, we have not been in the multifamily space. So I'm a new emerging developer, just like you all. So I sent it out to my network, to Julia's point, and as you're seeing, it's not what you know, it's who you know. So I sent it out to my network. Some said, yeah, we would love to look at the deal. LISC was one of the first. So I went with LISC. But through the conversation, another bank approached me. So I said, well, let me see what you got. So I was like, well, LISC, they are offering this. And then LISC was able to come back and say, no, we really want the business.
Right.
So by shopping the deal so that you can have the comparison of the terms and be able to go back to whomever you want to do business with, especially if their offer is not as attractive, is a negotiating power. But I cannot speak to it strong enough that it is all about network. It is all about people seeing you and knowing who you are. Because even with our rental property, when I first started, I'm new to housing, but I was not new to banking. I did not know what CDBG was, which is the Community Development Building Grant, which was critical in rehabbing our portfolio. And when I was calling people, I was calling the EFGP. I just know there's something out there. And the housing director at the time of Contra Costa said to me, it was clear you didn't know what you were talking about, but you were so diligent. We had to find a way to help you. So you have to be okay with showing your vulnerability that you don't know, but you're eager to learn. And please do not ever put yourself in a position where it looks like you're acting as though you know and you don't know, because it will trip you up.
That is such an awesome point, Nikki. And I will say I found that transparency has always served me, but you have to have a level of vulnerability, because it does not take a lot to be an originator or relationship manager, essentially the gatekeepers to your access to capital. And when I say it doesn't take a lot, I don't mean to demean what I'm doing, but they're looking for you to have a college degree. It does not matter what that college degree is in. And so, real estate, I think generally is a little bit, nepotistic, I think is the word I'm looking for. Basically, people hire the people that they know. And so if you happen to be the chief credit officer's son with an English degree, that does not preclude you from becoming a relationship manager. And the point of me sharing that is that sometimes if you don't ask questions, you don't realize if you're at the mercy of someone who also does not know how to help you. So sometimes the folks that you're interacting with or trying to negotiate with aren't being helpful because they can't. So it's important for you to know what the market interest rate is, what the market terms are. I have a sponsor now. He's doing a pre-development deal with all this expertise in remediation. He's cleaning up dirt that's benefiting the city of Atlanta. And so they're part of the capital stack as, through an investment vehicle. And the construction debt that he quoted us was for 6 to 8% rate. Actually, the first rate he gave was 9%. And I had to pull him aside. I said, we can't take on the construction debt, but it is not in our conscience to allow you to accept a term for 9% on construction. First senior position. That is outrageous. And, he said, oh, well, okay, we can get it down to 6 to 8%. It's dirty dirt. So, people shy away from dirty dirt. I said, no, 6% is at the top. That's inclusive of the fact that this is dirty dirt. Otherwise, this would be a 3% type of construction deal. So to Nikki's point, it behooves you to shop around and make sure you're keeping abreast of what market terms are, what market conditions are, because the rate in 2020 should reflect the response to COVID. And maybe there's a premium on the cost of capital because of everyone's fear and uncertainty. But if you're offering a deal that's within your expertise, you have projects that demonstrate your experience with that scope of work and that type of project size, there shouldn't be an additional interest rate tacked onto that. I mean, an additional premium tacked onto that. And then if you bring the same deal back around, say there's delays, you didn't get to build it in 2020, you get to build it in 2022, you should see that cost of capital come down in response to the market. But you can't necessarily just trust the lender or the originator to offer you the best rate. You have to be equipped to seek it out. I think that might be, oh, I want to touch on repayment. You can negotiate the repayment structure. So we talked about situations that might be interest only. We talked about situations that might be principal and interest. If you have a clear path to closing, let me share my screen again. Sorry, I stopped sharing. I believe this is, okay, I think you're looking at my screen again now. If you have a clear path to an exit, you should be able to negotiate whatever relief you need. So if the relief needs to come from not having to be responsible for the principal during your loan term, then make that ask. If you want to say, hey, I want to have interest only terms until 6 months after we receive our certificate of occupancy, then make that ask. There is no reason that you shouldn't have any kind of like debt service requirement, especially an amortizing debt service requirement tied to the anticipated performance of the property. If it's a retail or office and you have existing tenants in there and you look at your lease abstract and see, okay, when I acquire this building a year in, 25% of the units are going to turn, or 25% of the leases are going to turn. You do your research, find out what is the typical expectation for that rollover. Is it 3 months down? Is it some particular hardship relative to the location or some macroeconomic condition that makes it like a 6-month down period? And then say, hey, I'm going to acquire this property at this date. I know that it's producing, amortizing, net operating income that can cover an amortizing debt service, but I'm anticipating roll and I want a little bit of relief. So I want interest only for the first 12 months. If you're giving them a 48-month term, that should be something that they're willing to do. So that's one aspect of negotiating. I think equity requirement, just making sure that you are clear on what that LTV ratio does for your equity requirement. And then extension options, making sure you really understand what it takes for you to be able to extend. I typically tie the extension to either the certainty of the exit or a performance hurdle that makes me feel comfortable with increasing the options available to you for repayment. I'm gonna move on. I know it's 3:46. Nikki, how am I doing with time?
You're doing fine. We have until 1:30.
Okay, so let's talk about the overly optimistic developer versus the pessimistic underwriter. When we look at your pro forma model, we do not want to see pie in the sky gross rents and revenues. We don't want to see other income that can't be substantiated and overly aggressive operating expense reserves. So some of these numbers are tongue in cheek, but the point is make sure you've researched the market, be able to support your assumptions with what you see happening in your submarket and how it relates to the overall market. So Titus, since you're off camera and I can see you, which neighborhood or which borough in New York are you in?
I'm in Harlem.
Okay, so Harlem, and I'm not totally abreast, but I remember when I went to Harlem back in 2006, and then I've seen on TV Harlem now. So, in 2006, if you brought a renovation project to a bank and you had market rents, I don't know what they are now, but whatever they are now, if you had them back then, they would say, they would start to question your abilities. If you're able to go into a bank today and use the existing renovated properties as a comp and support those assumptions, there's not a reason that you shouldn't be able to get a leverage point that is in consideration of supportable market data. Operating expenses, even now, this differs. Even if a property that's adjacent to you is achieving some extraordinary operating expense ratio of like 25 to 30%, typically a lender is still going to underwrite at minimum to 35%. A lot of times you want to look to what the standard is for the asset type, and multifamily is just 35%. And I'm not sure if that's related to people underwriting to HUD and looking at what a HUD takeout will be, since that's a very favorable product for a lot of owner operators, or if that's just an agreed upon standard. But 35% is typically the lowest. But you do want to look at what is your structure. Are tenants taking on most of the direct utility costs? Is your property smaller so that they're also responsible for what in a larger property would be covered through overhead? You want to take all of that into consideration. This last point, 10 deals per sponsor. Sometimes developers will talk about their robust pipeline as if that's a good thing. And it is. It's a great thing for you all. For us, it's just risk. Because we want to know that, one, your attention is focused on the deal that you have as financing. But also, we want to know that your balance sheet can support all of the contingent liabilities associated with those other deals. And so that's why there's so many invasive questions. I'm sure it feels invasive when it comes to requesting your financial statements. It's trying to make sure we're clear on all the contingent liabilities that you're taking on and where we fit in as far as financing the deal that you have in front of us. The last point that I wanted to make relative to this slide is deal approvals. When you have a deal turned down, I would say ask what the reasoning was, because in 2020, no construction deals were getting financed. And that's again because of COVID and people's uncertainty. How is construction going to be managed? All the delays. It just had a lot of institutions nervous. That changed in 2021 and it's changed in 2022. So it would not have been a reflection of anyone's specific deal if it wasn't approved in 2020. It's a reflection of macroeconomic pressures. The other point is that when you're dealing, especially when you're dealing with a fund, but even at the bank, there's a requirement to monitor your portfolio. You can't be top heavy in construction and think that you're going to survive something that happens to all the deals that are impacted by delays in the construction industry or increase the cost in materials. Like that's going to impact your portfolio as a bank, which puts you at risk in terms of the liquidity requirements put on banks. And as a fund, it's going to put your portfolio at risk in terms of looking at the overall returns that your assets under management are able to achieve. So it's important for you to know, is it my deal, or is it a portfolio concern, or is it macroeconomic pressures? Macroeconomic pressures, you can kind of gauge that by keeping abreast of the news. I prefer to use CNBC and Bloomberg, but however you get your news that covers the market. Is there someone trying to speak? Okay, just checking. So, that's important so that you don't stop pursuing your deal in the event that it has nothing to do with you. You keep shopping until you find a lender.
Julia, and I just wanted to make this point too, that, many of us will be intimidated by this process. So the no may just be no for now, but to your
Right.
point, understand the reason for it so that either you can go back, tweak, change, adjust, and understand if you wanted to bring it back, what can make it more successful. So please make sure you understand and not, feel intimidated that you're not in position to ask and understand why.
Yeah, that's a great point, Nikki. And going back to your comment about being vulnerable, and then my comment about folks being unhelpful sometimes because they can't be helpful. Don't let someone's response to your questions dictate your persistence about getting an answer. Because I've seen it firsthand where lenders acted just like it was an affront to have someone ask them questions. And then as I've been able to observe, I started to learn that's because they didn't have the technical skill set to be able to understand how to answer. And so instead of just admitting that, they tried to avoid responding to the client. Titus, this might go back to your questions about the capital stack. Some people refer to them as tranches. I just never got into that kind of lingo, so I'm going to stick with capital stack. But in the event that you're familiar with tranches, these are the different tranches: senior debt, mezz, preferred equity, common equity, and they're ordered from risk, low to high, and that's the risk to the capital source. So the person providing the senior debt has the lowest risk because that requires repayment. Mezzanine debt, preferred equity, common equity, it increases because there's fewer remedies to get repayment. And with that risk, the higher the risk, the greater the return. So the capital for senior debt is least expensive. The capital for equity tends to be the most expensive. And it's important for you to know the market for your equity too. And if you're going to take friends and family money, I would say the ethical thing to do is to know what the market is for them so that you can help them become sophisticated investors too, especially if they're Black and brown investors and they're in our community. You want to make sure that as they're investing in you and helping you grow your business, you're helping them to be solid and sound about how they put their dollars to use. And if you're not going to be able to offer them market, at least you're able to tell them, this is the rate of return. As I grow, we can talk about a different return structure. All that to say, just be mindful of how you structure your capital stack, because your weighted cost of capital is what you'll need to monitor too in terms of looking at your refinance options or your options to sell it on the market once you've delivered it.
I'd like to just follow up for that for common equity and just equity in general. At least for other debt that you're getting from a bank or from a lender, the market rate, you can either find that out as it's advertised on a website or you can call them. But I'm not too familiar with strategies to figure out what's market rate for equity. Do you have some suggestions there?
So I'll offer my lens, but if anyone else on the call can, a lot of my experience and exposure is institutional. And there are a lot of funds that one of the ways to expand their market reach, they have resource pages. And so prior to pivoting from a lending institution to a fund, I had done a lot of research through NAIOP. I don't know if you're familiar with NAIOP, NAIOP. It's an organization, but it's also a source of research, just like ULI. I forget what NAIOP's acronym is, but I've used their website when I was asked to help someone build out a fund. And it talks about opportunistic strategies, value add strategies, core plus strategies, and it tells you the pricing. Now, obviously, some of that data is going to eventually be stale, but it gives a large enough range that it's still relevant. For preferred equity, I know that like in DC, there's a DC related institution that provides preferred equity, and they would have that information available to you. I think that it depends on the capital provider where you can get preferred equity pricing from. I don't think it's necessarily in response to the market. If it's a mission focus, it's in response to their ability to achieve the mission and what they need to keep their business running. If it's just a neutral institution, I think that would require you to just ask around and shop it. Is there anyone on the call that's actually done that though? I don't want to limit the insight that I'm offering just to institutions. If you all can offer other resources or insights.
Julia, can you share the acronym again, NAIOP? I'm gonna put it in the chat.
Yes, NAIOP. And I'll just, can you still see this? Or are you only seeing, oh yeah, you're only seeing my screen. I'll share the link, Titus, that I actually used myself when I was studying. Let me figure out where's the chat. I'm gonna have to stop sharing because I don't know where the buttons are. Oh, here it is. Okay, so that's one, but it's NAIOP. And Nikki just put in the general website. I put in the one that's tied to the research.
And Julia, in working on getting feedback, and since we do have a small group, has anyone approached, friends, family, or other equity partners in relation to some of the projects that you are pursuing or currently working on? And if so, do you want to share that experience?
I have a little bit of experience with it, but not in the sense of going and executing on a project, but more so just starting the conversation, finding out what someone's financial goals are, if they've considered investing in real estate in any type of way, whether it's as a operating partner or a funder or equity partner. And trying to really gauge like what is it that, how much would they like to invest and what is the return that they're seeking on that investment. It never actualized into acquiring funds and solidifying a contract and executing. But that's just been my experience. It's been fairly high level, more so what is their vision in that regard, what kind of communities would they like to impact, but not necessarily any more granular than that.
Thanks, Titus. Is there anyone else that has insight? You all are making me feel like one of those bad preachers where they can't get an amen.
Don't take it personal. It's just all this is information.
Okay,
Information.
okay.
Everybody just seeking it in.
Okay, all right. I'll pretend I'm getting some hallelujahs and
Amen, hallelujah.
and preachers. Okay, I'll move on, but I also dropped in the chat. I didn't realize I was only sending them to Nikki and Dolores. I dropped in the chat NAREIT references an index, a real estate index. So if you're familiar with the equity markets, they talk about the index this, the index that. It's like that baseline. And a lot of times when you get quotes from a bank, they'll reference an index and then offer you a spread above the index. You can consider using NAREIT in the same way. I'm just not advocating for it because I don't have a lot of experience having done it. And I don't want to, encourage you to do something that I don't fully know about.
I feel like that's a little bit challenging because I haven't looked at the index, but it seems like that would be from rates of the past and also kind of the current rate, but there's nothing really to tell you the rates of like the future.
Yeah, the way you typically use an index is just to say, here's a comparison of how you can use your dollars. This is the interest rate for a savings account. This is an interest rate for a real estate investment trust. If you wanted to just deposit your money, through a brokerage account, invested into a REIT. And this is what I'm offering from my project. It's just a reference point. It's not really to help you predict or project what you should be offering.
Gotcha. That makes a lot of sense. I appreciate that.
Okay, exit strategy. Hold on, let me see. I want to make sure that because we talked about, okay, all right, great. So exit strategy. This is another way to, going back to your question, Matt, this is another way that I personally, it's a tool for me. I use it to get through deals that I don't think I can get my committee members comfortable with. So for example, I have a travel center deal. For those of you who don't road trip, think of a Flying J or a Pilot. I can't think of any others, but just those large gas stations that offer you restaurants and, a convenience store. And so that travel center is being completed by a 5th generation businessman in Alabama. He's successfully managed a general contracting company that works with, the armed services, think, Army or Navy Corps of Engineers, but has not run a travel center. And, I underwrote the deal. I felt comfortable with him as a sponsor, his integrity. I made some recommendations in terms of consultants that I wanted him to hire to sound up the operations and make sure I was mitigating against operational risk. But at the end of the day, travel center, one, not a desirable asset. Businessman that does not have experience running a travel center, sponsorship risk, operational risk, and then a large investment from us relative to our fund. So I leveraged the exit to help get folks comfortable. A commitment from the SBA to take out the loan and, the timeline that they needed before they can offer a firm commitment, and how much cushion we have before the end of our loan term and when they can offer a firm commitment. And so if you come to the table with a strategy, a business plan, and a sound exit strategy, I think that you then kind of give yourself the leverage to negotiate. Because at the end of the day, without you, banks can't lend, funds can't invest. So you yourself are an asset and you're bringing us an opportunity to invest. I thank my clients for the opportunity to invest. And so just make sure you're presenting multiple exit strategies. So it's low risk if there are multiple exits or if there's certainty. With HUD, you can get a firm commitment, capital F, capital C, an actual stage in that process. With other institutions, you can negotiate it. I think Goldman Sachs has offered firm commitments, or whatever the terminology would be. You can ask for another lender to offer a commitment letter that's evidencing that they've gone through their approval process and have committed to the terms that they put in that letter. You want to be careful though, because we as a fund can offer a commitment letter, but if you read the language, it tells you that it's a non-binding commitment. But when it comes to a bank, that document is a binding commitment. So you want to make sure you read it carefully and are careful with the terminology so that you get the document that you need. But if you have all of these things in place, you reduce the risk that your project presents to the institution. Any questions here?
No, but I do have a comment, and my hallelujah is when I pop up to say this is important, because this goes back to you sharing the skill and expertise of the originator, loan officer, whoever you're dealing with, because they may only look at the face value. And just to what you said, sorry, you don't qualify. But if they don't ask the question, well, you don't, qualify on face value, but let's talk about the exit strategy. How can we make this work? So it's again important, understanding your no will also validate the interest, the desire of that individual wanting to see a path forward. So do keep this as a gem, because you will, as a developer, not a new developer, not maybe at face value strong, but if you have a strong exit strategy, that could then be the thing that turns that deal around.
Yeah, excellent point. Excellent point. And, home ownership, that's one of the asset types that, people tend to shy away from, institutions tend to shy away from, because you're subject to the market conditions. Our home price is going to stay stable. Are folks feeling good about their income? What's happening with unemployment? There's so many variables that go into the home buying market or home selling market. Folks tend to shy away from it. So, being able to say, oh, as an alternative, we can, rent these units out, and here's the analysis on a rental scenario. Or you can say, no, we've done extensive market research and have secured a sales broker that's a part of our team. And this is the plan that they've devised, and this is what they think about the timing. These are the things that I've seen done when I've been working with my wealthy, large institution white sponsors, especially like condo deals or single family deals or townhome deals. You leverage the strength of your project team relative to the exit. You leverage the players in the market for the exit. And, this is really the last slide. I think we already covered, strengthening relationships earlier in the conversation. So this is really the last slide that I want to go over and make sure you all can take this in and use it to your benefit. How do we look at sponsors? A strong sponsor has deep experience with the project that they're talking about, the asset that they're working with, and the budget size, the project size. They also have liquidity, and liquidity is important because it needs to be available to pay down the principal. That's why it's hard when people are real estate rich and cash poor, because we can't liquidate that to repay our principal. So that would be a strong sponsor. Additionally, if they have a relationship with someone who has deep pockets, someone with a lot of money that's standing behind them, or they themselves have a lot of money, and then connections to the directors. I can't tell you how many conversations, and I've had the luxury and disadvantage as a Black woman of being invisible in a lot of meetings and hearing things that I probably wouldn't have heard otherwise. People have vouched for nephews of the director, friends of the cousin of the CEO. It's this familiarity that buys them credit and strengthens them as a sponsor because someone knows them. So that's why I have network on here. That's on the left. That's somebody that's very strong. On the right, I have high risk emerging developers. Sometimes this is rightfully so because there's limited direct experience. Maybe they're cash poor, but real estate rich. Maybe you're having to leverage the reputation of their work product versus an extensive portfolio of completed projects. They have a solid, reputable project team, and they have decent reputation in the market through their network. but there's still a high risk, relative to just being able to pay down the principal balance should something go awry, or their direct experience right sizing a project if it went wrong, or surviving some market condition. Like folks that have survived the Great Recession are golden. It's like, oh, if you were able to stay afloat during the Great Recession, that speaks a lot to your abilities and your integrity. But if you look here in the bottom right corner, I have developers of color. And there's a term, implicit bias, that gets thrown around a lot in both real estate and in investment management. Gatekeepers like me, like investment consultants, when it comes to folks, if anyone on the call has attempted to access institutional capital like pension funds or other private equity funds, that implicit bias means we're not seeing you as James or Ayana or Dolores. We're seeing you as someone we don't know. And I'm saying we, but I definitely don't include myself in this category. But I'm just saying we, so you understand how pervasive the problem is. So when we talked about earlier, making sure that you are advocating for yourself and making sure people see you, if you look closely, this box here that says developers of color has the same credentials as that strong, experienced sponsor. You have to make sure people are taking the time to understand your background. And, I've not experienced it from the developer standpoint, but I've experienced it as an individual. Brown University is an Ivy League, and I've gone into an interview where the interviewer wouldn't shake my hand and told me that they're looking for candidates with Ivy League degrees, only to then embarrass himself by looking at my resume finally and saying, oh, I see you went to one. And that's what I mean about people not seeing you. It's not for, a sob story, but it's just the reality. So just make sure that you're advocating yourself, because whether the person means to do it or not, that implicit bias exists. And it's important for you to make sure that your story, your project strength, your background, the strength of your project team is really being told and conveyed when they take your deal before the committee. Because the credit committee is not meeting you. They have to rely on that gatekeeper to tell your story. And with that, I think that's all I have for you.
Well, on that note, I have to, since that's going to be our common theme, amen, hallelujah. Because your transparency, especially understanding your group and being able to speak so eloquently about the real life biases, hopefully we'll prepare those on this call to be prepared and to know how to navigate and call it out when they see it. So, again, I always say it's not about what you know, it's who you know. And I'm always so very gracious and astounded of all the great people that have come into my network. So this is your time. Everyone else who may have questions about the presentation, what has resonated with you, your walk away. So please, let's have a moment of dialogue so we can get you on to your day, but would love to get your feedback about the session today.
I thought the session was excellent. Julia, thank you for such a refreshing, open, honest discussion about what you face in this industry. I thought it was great.
Thank you. I'm glad it was of use.
And that's coming from a veteran who probably experienced many of those things before it even had a name. So thank you for that validation, James.
Yes, thank you.
I feel juiced. I feel armed. Like I appreciate this information so much. I'm truly energized from it. Like, it's like every time I come to one of these webinars, I'm getting like big chunks to just meet. And so I appreciate everyone that's been a part of this. Thank you, James. Thank you, Nikki. Thank you, Julia. And thank you, Dolores, for assisting with putting all this together.
Well, the good news is it's recorded, so everyone will have access to the recording. And Julia, we didn't ask, but will you have any issue with providing your presentation just as a reference, a point of reference for those that joined us today?
Yeah, absolutely. It's got the disclaimer in there for that reason. So I will send it to you and you can disperse it. I just dropped into the link Adventures in Commercial Real Estate. They have templates. You can use them to study for free. If you choose to use them in practice, you can pay a fee, and that way it'll stay updated. You'll have access to all the future updates. But I found it to be an incredible resource, not only for the templates, but for the amount of information that it has, and just helping you to understand, the lens of these are asset managers, but essentially the folks that look at the equity and the debt.
Well, in closing, thank you again. And thank you, Titus, for validating how important, just, as more you hear it, the more it will start to make sense and you'll start connecting the dots. And really would implore everybody to use the assets and the resources, because when you go into these conversations, to Julia's point, they're not going to expect much from you. But when you can talk the lingo, well, you didn't approve me, but can we talk about my exit strategy? Can we have that conversation? Or is this the best interest rate? Because when I did my research, that doesn't look. So when you get very familiar with the terms, that bias will say, oh, okay, I guess you do know what you're talking about. So please leverage the tools that were provided. We'll also make sure that the links that we talked through the presentation is also shared with you. And I could just assume, and I don't want to maximize Julia's time, but I'm sure if you wanted to interact with her directly, I know that her door would be open. So
Yeah,
thank you for that.
I'll drop my LinkedIn in the chat, and I know that folks have dropped off, but feel free to share that. I would say that LinkedIn is a good medium, because if you email me, because my email is in the deck, if you email me, my expectation is that we're talking about a deal, whereas if it's on LinkedIn, I have time to come back to it when I get room to breathe. So I'm happy to be a thought partner. My goal is to be helpful.
Well, thank you. Thank you. Well, I'm going to be in DC the later part of April, so I'm going to take you out to dinner.
Give me dates. I would love to see you when you're here. I want to make sure we block off that time.
Yeah. Okay, well, I'm going to stop the recording. Thank you all, and